If you're not careful, you could lose millions of dollars to taxes by investing your money in the wrong way. So today let's talk about the best tax-free and tax-efficient places to invest your hard-earned money to maximize your returns and, of course, keep as much of those returns in your pocket as possible. All right, let's jump right into it. What is going on, everyone? I hope you are all having a fantastic day. So, first of all, is it actually possible to pay $0 in taxes on your investments this year? Yes, there are situations where that is absolutely possible. However, the most likely scenario there is that you either did not make any money from your investments, or maybe you even lost money, or you just didn't sell any investments and therefore you have not realized the profits yet, and therefore you currently don't owe any taxes on those profits. And of course, there's the last possibility that you are guilty of tax evasion, but we're not going to talk about that one in today's video. So what I'm trying to say here is eventually the government is going to come for the money that they are owed, even on your investments. And in today's video, I am not talking about tax avoidance, but rather how you can use tax-efficient strategies to minimize the amount that you owe and, of course, keep the maximum amount of profits in your pocket. Okay, so the first and most obvious way to invest in a tax-efficient way that is really widely talked about would be using a Roth IRA or a Roth 401k. Now, I won't bore you to death with the details in this video because this is a very widely talked about topic, but essentially with a Roth account, whether that's an IRA or a 401k, you are electing to pay the taxes today, meaning when you withdraw that money in the future, it is now able to, number one, grow tax-free, but you can also pull that money out without paying any additional taxes. If that was a little bit confusing, there are a million videos and articles online about how a Roth account works. However, that involves paying taxes now, and we want to pay $0 in taxes on our investments this year. So how can we go about doing that? Well, the first option would actually be what's called a tax-exempt mutual fund, or similarly, a tax-exempt ETF. That probably sounds great at first glance, but unfortunately, this usually involves a mutual fund or ETF that is heavily invested in what's called a municipal bond, which is basically a bond issued by a local government that helps fund local projects like improving the roads or building a new school or stuff like that. And essentially, the way that this works is you're basically lending the government money, and they will pay you that money back with interest. And of course, all of the profits that you make in the form of interest is then exempt from federal taxes. So obviously, a tax-exempt mutual fund or exchange-traded fund ETF is just buying those municipal bonds in a diversified way, and in any normal year, this would be a great way to invest your money tax-free. However, we are currently headed into 2022 with inflation rates that are higher than we have seen in a very long time, and a municipal bond is actually a pretty terrible investment as a result. Because even though you're earning that interest rate on that money, inflation is going up way faster than you can earn interest in most cases, meaning that the dollar is being devalued, and therefore you'd be lucky to even break even on this kind of investment right now. However, definitely a great option and something to keep in mind in the future when things are a little bit different in our economy. So the next best place to invest your money that is probably a much better option for our current economic situation would be what's called a health savings account, or HSA. Essentially, this type of account allows you to set money aside and save for future medical expenses while also reducing your taxable income. I know that was a lot of confusing jargon, but just like you can take money from your paycheck and put it into a traditional 401k and therefore reduce your income, you can also take money from your paycheck and put it into a health savings account. So for the sake of simplicity, let's say that you earn $100,000 for the year, and let's say your effective tax rate is 30%, meaning you would owe $30,000 in taxes. Well, instead, in 2022, you can contribute up to $7,300 for family coverage into your HSA, which would reduce your taxable income from $100,000 down to $92,700. And now you only owe 30% tax on that amount of money, which would be $27,810. I realize that that may have sounded really confusing, and it's not going to really net you that much money, but this is still still over $2,000 that is going directly back into your pocket, and that sounds pretty good to me. Plus, you now have essentially set up an emergency fund for medical expenses for your entire family, and that is pretty awesome as well. Now, what if you also maxed out your 401k contribution and your traditional IRA contribution? Well, the 401k maximum is currently $19,500 per year, and the IRA maximum is $6,000. So if you take those two numbers and add the $7,300 that you can contribute to your HSA and subtract that total from your $100,000 of income, that means that you just reduced your taxable income from $100,000 down to just $67,200, meaning you would now only owe $20,160 in taxes instead of the original $30,000, plus you just maxed out 2 different retirement accounts and you set up an emergency fund for medical expenses, all while saving nearly $10,000 in taxes, which again is money that goes directly back into your pocket. I want to be clear that I am not a CPA, and while I do love tax law and saving as much money as possible, you definitely want to talk to a financial professional to get specific advice on your situation, but I would definitely go to your CPA or accountant and ask about an HSA or the other various retirement accounts that I just mentioned. Similarly, the next tax-free investing strategy that is more of a niche-down option but can be very effective is what's called a 529 college savings plan. Now, this is something that is offered at the state level by nearly every state here in the US, and essentially this is an educational savings account that has the same tax advantages as some of the previous accounts that I just mentioned. And what this means is not only will this investment grow tax-free, meaning no additional taxes when you withdraw this money for qualifying educational expenses, but a few states actually allow you to deduct those contributions from your taxable income. Full transparency, that is actually pretty rare, and in most states you're not going to be able to deduct that contribution from your income. However, that effectively makes this like a Roth IRA, where you do have to pay the taxes on it now and you're not able to deduct it from your income. However, that money is going to grow tax-free, meaning when it comes time to withdraw it, you're getting a lot more bang for your buck. And considering the cost of tuition at the average university continues to outpace inflation, planning now and setting that money aside while your child is young could be the only way for them to attend school without accruing ridiculous amounts of life-altering debt. So there are many other niche strategies that you can look into if you are self-employed, with things like a SEP IRA and even tax incentives for real estate investment properties. But again, you'll want to talk to a financial professional who can actually look at your specific situation and give you the best advice possible. But at the end of the day, I hope what you take from all of this is that, number one, there are actually very few options that are truly tax-free, and if anything, they are just tax-deferred. So instead, the word that I really want you to remember is tax-efficient, meaning are you optimizing when you are paying your taxes to maximize the potential profits within your investments, and of course, minimize the amount that is taken out of your pocket. But of course, I don't want you to get too caught up in all of this confusion and feel like you have to get it all figured out before you start investing, because I promise you, doing something and investing in some kind of account, even if it isn't necessarily the best, most tax-efficient option for you, is better than doing nothing at all. In most cases, you can always transfer that account to a different option, and there might be some fees and taxes that you have to pay as a result, but really getting started as soon as possible, whatever type of account that is almost always going to be a better option for you in the long term, rather than just sitting around and waiting to figure out how to be the most tax-efficient investor possible. I've been investing for several years at this point, even though I'm still pretty young, but I've only recently started to figure out how to truly optimize those tax-efficient strategies for my own situation. And while I have had to transfer a few accounts and pay some small fees as a result, I am sure glad that I got started when I turned 18, because that has already set me up on the path to achieving financial freedom earlier than most. So if you're still here at this part in the video, first of all, thank you for sitting through some of this financial jargon that personally I love, but I know isn't always the most exciting thing in the world. As always, if you did get value out of this content and you want to help support me, the easiest way to do that is actually by checking out some of my favorite financial tools down in the description below, including one offer from the Point Cashback debit card that will currently give you $100 when you open your account and make your first purchase, so definitely check that out using the link down below. Be sure to hit the like button and subscribe to the channel for more content like this in the future, and of course, thank you so much for your time. I really do appreciate it so much. Take it easy, and I'll see you in the next one.